sister division in well, in WPP to GroupM. And I would say, you know, a hardcore digerati. Prior to Real Media Group, Ari was with 24/7 Real Media since 1997. So we'll get a little bit into his background, but mainly I want to get a little sense for what he's thinking since he's pretty new to the job. So Ari, thanks for being here. Okay, so like I said, one of the things that excites me is the sense of openness and transparency, and the idea that, you know, these markets will make the process more transparent for the world to see. On the other hand, that's kind of like antithetical to the history of big agency holding companies, particularly GroupM, which, you know, so much of your market leverage and your clout comes from the fact that you know it better than other people, and you can do things behind the scenes to get advantages for your clients and their brands. So how do you reconcile those two things, where you're operating more and more in these open markets like RTB and programmatic, where the supply is transparent and open, but how do you retain your competitive advantage in that? I mean, I think that's a big paradox that I'm always trying to understand.
Yeah, it's a science. I mean, the mix of partnership and obviously, like you mentioned, competitive advantage for our clients. They're both very important, but obviously our clients need to have the best pricing, the best performance, and continue to have that competitive advantage. So with the partnerships itself, coming up with ways that we can actually grow that competitive advantage in the marketplace. It's not just the amount that we spend, it's how we go about it. As RTB continues to evolve, and the bridging of really all media coming together, so that it's not just display banners being bought in an RTB fashion or video in an RTB fashion, but bringing together really the full gamut. So, you know, television itself, radio. There's some evolutions that we just announced recently, you know, actually yesterday, regarding radio, bridging the gap there. So really, it's the entire package, and bringing together and allowing publishers, data companies, tech companies to come together and gain that competitive advantage with us. That allows us to accomplish our goals, keep the market growing at a tremendous rate, and really, you know, accomplish everyone's goals and objectives here, which is for the marketplace. I can assume, and so far with the 600 or so partners that I've met with in my last 4 months, growth year over year is pretty much everyone's key objective. So assuming that holds true, we can bring that to the game, and then our clients obviously need that competitive advantage, that better performance and pricing.
Well, I want to come back to some of those cultural and organizational questions I started off with, but you started going into the portfolio, and I think that's a really important development. And I'm surprised at how fast other media are becoming part of this programmatic marketplace. And just in the last week, you mentioned that your sister division, Xaxis, did a deal with Triton to start trading radio impressions, which was a surprise for me. About a week ago, your other sister division, SpaFax, developed an exchange for digital out-of-home media buying and out-of-home in general. So right now, you can do display, video, search are the key biddable media, but you now have out-of-home, radio, and I think a little bit of TV starting to, you know, get in there. I think your company is an interesting company because one of the other things is GroupM is a big investor in NVIDIA, which is one of the key technologies trying to develop an addressable TV infrastructure. But that industry is so, how can I say, as bad as the premium online publishers are, the television industry is just kind of really loath to trade this way. So why don't you talk to us a little bit about the mix, the portfolio. How much of it do you see evolving into these other traditional media? And what are the big obstacles to getting them on stream?
The biggest obstacle, clearly, and I'll start, and some digital folks, and I've been doing it for a while myself, but some digital folks might not like what I have to say about that, but I've been selling tech and media for a very long time, and now I was traded over to the other side to help strategize and buy and invest. But, you know, television is obviously the holy grail. I mean, that's the real money. That's the big money that's going to help drive everything forward, or at least to whole new heights. And we're doing great work already helping to bridge. So we did some beta work a year ago. And you know, what's a decimal point in a very small place for TV is a pretty big number for digital itself. This year, it was actually part of our upfront strategy, where certain partners were able to express and really follow the consumption. So they were able to express digitally through FEP. We're able to run and reach those audiences the way they would in a television situation. That continues to evolve dramatically, and what's missing, or what we have missed, or at least in my opinion, is that we missed a common standard of metrics that allow us to understand apples to apples. So as a digital seller and evangelist for a very long time, we've always said, like, we're accountable, we understand, we're real time, we have all this great stuff. However, what we never did was build an apples to apples comparison of what this equates to compared to what people who have been doing it for a lot longer know about their day-to-day.
Well, that was one of the key innovations with Spofax developing the out-of-home network, was that you had so many different kinds of facings and exposures in the out-of-home industry, and they had to work with Nielsen and other suppliers to develop at least a common denominator. But you kind of had that with television, with the GRP and the CPM, and now I guess maybe can you explain what the big obstacle is in terms of retrofitting that into the digital metrics and what you need to overcome?
Yeah, again, within my own family, my day-to-day, a lot of people don't like this thinking, but we need a GRP in digital. And I'll say it for this room, because most people understand, we'll believe from digital world, we'll believe it's a step back because we have so much metrics, because we believe in accountability, because of real time. However, that apples to apples comparison will allow us to take maybe even 10 steps forward by doing so. It's got to happen. And what we see, and just natural evolution with anything, an engaged client will understand, once they can understand that this, which I know produces X amount of sales, is equivalent to this in all things digital, they will be engaged and they will ask, what else can we do? What other metrics can I bring to the table? What does engagement truly mean to add to the equation? We just went with the metrics and continued to metric without that apples to apples bridge. So it's going to be fast and furious, and it is now. It's not. Right. We're not looking out a year, 2 or 3. This is happening, and this is now.
So, I mean, one of the things that also surprised me when I learned about media was that for the most part we were buying proxies, just estimates of the audiences that the advertisers wanted to reach. And Nielsen ratings were just that. They only call them estimates. They're not actual audiences. And that's been true up until the shift that took place a few years back, where agencies developed trading desks and started buying based on the audience. Now, yeah, it's still a cookie proxy, and you got to assemble it and work through DMPs and all this mishigas, but the reality is, in theory, you're buying people. So now why do you want to retrofit it to a GRP when you have the ultimate, the holy grail, the person? And how do you do that?
Well, it starts with the apples to apples. You need, like, if the biggest brands in the world that have been buying TV and continue to buy TV in a major way, and if you compare it to the dollars spent in digital, it's small numbers. It's not comparable, and they know, and these companies know, and it was news to me. As a digital seller, I'll say it again. For 15 years, I was wrong. I was misinformed. Is actually not wrong. So misinformed. Let me stick with the not wrong part. I like that. But the amount of understanding and education, the amount of data and intelligence that goes into television planning, buying, impressive. Blew my mind, actually. It was the second day at GroupM when I had my full day lesson. And I continue to abuse them for more information because it's impressive stuff. I did not know that. Okay. We thought it was prehistoric, it's Flintstone-like, but not the case. There's variables they bring into the equation that digital does not touch today, or at least yet. But big brands know what a GRP means to them. Right. They know the risks associated with making major shifts to that plan and that process. I don't know if brands can do that today with digital.
Okay, so you definitely drunk the Kool-Aid, and GRPs will be the trading commodity for, well, I guess all media, and that kind of makes sense when you look at the clout and the budgets of media that exist in the world. But I guess it also comes down to what type of brand and agency's buying it, because the direct response people have always looked at things like conversions offline, and they continue to look at them online. I think that's one of the big, you know, conflicts in our industries. You have different people talking about different goals and outcomes as if it's the same thing, but it's really different. You're talking about brand marketing for the most part, right?
Well, no, I think that, well, not necessarily. I mean,
Okay.
I think that overall, you know, selling into it and now being at GroupM, you know, I think the overall understanding of KPIs, the understanding of what you can accomplish, and then closing that loop still has a lot to be, there's a lot to be desired there. Some brands are doing it very well and doing some really beautiful stuff to bridge in-store sales versus all their media tactics and normalizing it based on, you know, radio infusion and or, you know, their television schedules. So really some deep-rooted stuff, but not all the brands are doing that. Because there's a lot of work involved, there's a lot of education involved, a lot of understanding, a lot of, you know, a little bit of risk-taking, a little bit of trust. So, you know, we continue to tackle those, you know, 1, 2, or 10 at a time, but it's still, you know, that education, that knowledge flow. I mean, those are the common themes from big brands about, you know, what we're talking about today, what we're talking about right now. Education flow, knowledge, and overall measurement are the number 1, 2, and 3 things I get from every client that I've met with thus far.
Okay. I didn't mean to talk so much about media trading per se, but and not TV, but since we're on, I just want to understand from your perspective, you know, this is not the first time people have tried to trade TV through, you know, online trading systems. There was a push back in the late 90s and early 80s. I'm sorry, late 90s, early aughts. You know, platforms like MediaPost and AdAuction.com, and they failed. And then there was another bout about, I don't know, about 6 years ago, 7 years ago with Microsoft's Navic and Google TV ads and Spot Runner. And they just never really took off. I think the DR people loved it because even though it was remnant inventory, it was working for them. What does it take to get those big network, you know, suppliers to get in this chain? What would they have to see? Because as you know, in the publishing, online publishing side, there's still a lot of reticence from the premium publishers to even participate. What do you need to overcome?
So from the TV side, I don't expect them to, you know, another question we've always asked is who's going to control it when that comes down, and my answer is a very quick one. It's the TV budgets. Right. So I think one of the barriers that we'll face, or one of the evolutions we'll have, is that, you know, the buckets themselves, how brands go about spending their money, is what's going to change, right? So it's this much goes to TV, this much goes to display, this much. So all the tactics are ironed out. But if they were actually to simplify their world and just have one line item of marketing, and then underneath that have different tactics that are interchangeable based on goals and objectives, I mean, it's common sense. It makes sense. But changing incentive plans, changing structure, taking risks, learning, that's a long way to go. So TV coming into our world, we'll operate it, we'll help them educate.
Sure.
But coming into our trading structures, that's time. That's time away.
Okay, so we won't be buying the upfront through machines anytime soon.
No, we'll be helping them to place media that helps them extend their audiences and potentially generate other performance metrics that allow them to understand even better what this can do across those platforms. But yeah, with buying it on buying television on a cost per click is not going to happen at least in my time, or at least in the near future.
So tell me a little bit about your organization, how it works. I mean, and really why you're the ideal guy, and are you the prototype for the new digital trader? So you work with trading desks in-house, and I guess if your clients have some other, you know, favored nations, you'll work with them. You have other outside suppliers, you know, in the programmatic exchange business that you work with. But you still work with your traditional agencies like Mindshare, and Media Edge, and MediaCom. Explain a little bit like what the day in the life of, you know, a digital investment person inside GroupM is, and how much of it's spent with the machine side and how much is spent with the haggle side.
That's a good question. Am I the ideal? So I'll go with a no on that one. I'll take the humble approach. What's the day in the life?
Yeah, I mean, how much of the process is spent doing it the old-fashioned way, to put it simply, versus working with algorithms? Yeah,
so I guess you know, I started in September. I guess officially, I was probably doing 2 jobs still. You know, closing out my day-to-day of 24/7 stuff for about 3 months. So But since September, what we've done is just continue to meet daily, talking 10, 12 different partners a day, 5 days a week. Just understanding differentiation, understanding what we're missing or potentially missing, hearing from them where we can be better partners to them. So breaking down some of those potential barriers there, learning what we should be screaming from the rooftops to the 140 plus CMOs that employ us just in the U.S., what we should be screaming from the rooftops to present to them that we're just maybe not hearing. So those meetings, and they're fast and furious, there's a lot of them, so breaking down those barriers. None of those meetings discuss price and haggling. So, I guess when they set up the structure, what our structure very simply broke down with is planning and buying are two distinct groups. So the strategic engineers, which are AKA the planning group, they are strategic. They deal with the client, they deal with goals and objectives, they lay out the KPIs, and then the investment group, my folks across Maxis as well, Maxis, MediaCom, Mindshare, and MEC, what they're doing is using data in order to decide and determine who the best partner is to accomplish those goals and objectives. The haggling part's actually pretty easy. So far, I have not raised my voice since September higher than pretty much this octave, which is different than the people that were bringing me in. Very different from my days at 24/7. I like the animosity and the fury. And anyone that I've worked with here, and there's a bunch that you get that. But here it's very simple. It's about growing digital, and it's about helping or my teams helping accomplish the goals and objectives of those data, media, and tech partners, which is growth, year-over-year growth. So if we can accomplish that, and my clients can get the best performance, education, knowledge flow, and pricing, then who doesn't win in that situation?
Sure. All right, and I know it's hard, and maybe you can't answer it, but if you were to put a percentage on the time spent right now in the org, doing it programmatically versus doing it humanistically, what's the ratio right now, and where do you see it going over the next few years?
Yeah, so we have an audience buying expert group in Xaxis, right. So they certainly take on a tremendous load there. Overall, audience buying itself, that definition could be cloudy because you can put ad networks in there who are also using RTB in order to then execute against their media. It's a good chunk about. You were talking 20, 22, 23% of the overall spending in the U.S. Okay. So it's a good number. But time-wise, the execution itself is predominantly done. Xaxis takes on and does that workload for all clients that work with Xaxis. And then each of the agency buyers, as we continue to set up, and some are further along than others, are building their own trading desks underneath their own structures so that for specific clients, they're able to execute against those goals and objectives.
Okay, so tell me about the human beings for a minute, because you must be the largest media buying organization in the world because you're the biggest buyer of media in the world, so you have a lot of people. Some of them have been around a long time. Some of them are younger Turks. I assume you're hiring a lot of gearheads and programmers and things like that. But what's the intangible emotional thing that you have to deal with now as people deal more and more with this thing and less with people across a desk or a lunch table?
Yeah. That's a great question. In theory, a lot. That worry, that fear, that change is obviously scary to a lot of folks. And as this business continues to evolve, you hear a lot, or you think you hear a lot of but that's my job, or what am I going to be doing? And and it's definitely something you have to continue to educate against and nurture. And I was thinking about the other day, and I'm thinking, like, if your job 15 years ago was to send faxes all day, and all of a sudden email came about and scanners came about, and you were the best faxer ever, and you're saying, oh my God, what am I going to do? There's everything else. I'm going to be obsolete. This realistically, that's not a good job, and you should evolve. So the same thing goes with this. I mean, where we're at today versus even 5 years ago is impressive. And if you come, and I tell anyone I've ever worked with or for that, if you come to work every day in this industry, and your job and your goal is to get through the day, you stand out like a sore thumb, and it just will beat you down. And it won't be your bosses telling you this isn't right for you. It's everyone around you, because the amount of energy, the amount of motion, the amount of desire to be great is just evident with folks in this industry, and it's fun. So you really, everything's going to evolve. So that fear is a short-term fear. It's a scare of change, but the folks that are doing this every day are excited about it, and that excitement leads to innovation, which leads to greatness and a desire to learn more constantly, and you flow with it. I mean, so again, 5 years, 6 years ago, this didn't exist, right. And now we have full days, full weeks, and businesses that are built that are pretty substantial businesses, and it's just the very beginning.
What is the one or two skill sets you'd recommend young Turks developing to get ahead? Should they be taking courses in programming and coding at General Assembly? Should they learn about how markets work? Should they, study trading? I mean, what's the most important skill set going forward?
Most important, and this is held true, and it's probably my only skill, is math. You have to be able to add, subtract, and divide, and multiply. Have to. And then again, anyone that's ever interviewed with me or heard stories, I ask a math question to, and it's usually what I consider a very simple math question to everyone I've ever interviewed. And I first ask on a 1 to 10 level where their math skills are. And they always give me a 7 or above. And then I ask them a question, say, throw one out there, like 70%, or 8% of 70. And most get it wrong, even this 8s, 9s, and 10s, or ask me if they can have an Excel or a calculator. But the idea is, what I'm trying to get from those folks that come in is simply how their brain's churning, right? Because if you just don't even understand how you potentially figure that out, there's some stuff you just can't do. But we teach it a lot, but that's the number one skill. This business is not hard math. There's no pi in any formulas, at least that I deal with on a day-to-day basis. But you have to do the basics. And from there, folks that were doing, some what I consider legends in this business, we're doing, tech support and are now running big businesses, right. Or we're doing account management and now running, CEOs of startup companies. I mean, so the evolution is it's how much you want to be great. But going back to your question, math is by far the number one skill you need in order to be great here.
Yeah, because it really is about how you think, not whether you can crunch a number in a macro or a calculator or a computer. A good example, Rashad Tabakawala, who's the chief digital strategist, said Viveki and Publicis started as the tech guy at Leo Burnett. So I mean, but he understood how to think and use machines to help him think better. One of the surprising stories I wrote in the last week was an annual review of Rocket Fuel, one of the data optimizers for the RTB market, and they had huge growth. And I asked them, what was it that they really did in the past year? And the answer was surprising. They said they actually got rid of all the need for human element, which tells you a little bit about how they think. But the point was, up until the past year, they had been using their machine learning and robots to do better real-time processing of the data, because the data is too much, even for your math geniuses to process. It's too fast, 100 milliseconds, right? But what they were still doing is they will, had protocols so that humans were going in every couple of days to see if the machines were running, meeting the goals that the humans set up. And they were. So they basically developed code that allowed the machines to check on the machines. So what do we need people for?
No, human element's not going away anytime soon, because realistically, you mentioned earlier big brands coming on board or are reluctant to bring into the RTB or the programmatic fashion, and I think the definitions of what we're looking for and trying to action are vast, right? So RTB itself, or exchange traded media itself, could be very scary to a publisher, and in a lot of cases I'll be very vocal with them that saying to not go that route. But machine to machine, so programmatic or the automation to make it easier, that's necessary. That's natural evolution. It's unavoidable. And we're seeing, after we discuss with big publishers or brands that are very, very, old school, I'll use that, they're very keen on that. There's no one that is I will never make my life easier. I will never, want to scale down or scale up people so that machines can handle. So yeah, the evolution is that everything at some point, and I don't know if it will be in my time, but everything will be machine to machine on the task-based stuff. But the rules set forth, the customization set forth, and that's human element. That is a human element.
Okay, just last question for me, and then we'll turn over to the audience. On that note, so you don't ever foresee a time where at a future OMA RTB conference, my robot in chief will be interviewing your robot? No? Okay.
Not in our time.
All right. Any questions from the audience? Tony, and then this gentleman.
Hi, Greg Smith from Tremor Video Hub. I'm curious. I'm really glad you guys were talking about GRPs and kind of because that's something that we've done with Nielsen OCR, and then essentially Nielsen has now made it available to about another 10 companies. But what I would say is we're getting a lot of interest from traditional marketers, but I wouldn't say we're getting a flood necessarily. And I'm curious, kind of where, what is it going to take to kind of get these guys to really, adopt the digital, the digital GRP, so to speak, to use it as part of their daily conversation?
So education is first, right? So that's ongoing, and it's fast and furious. But the first step, again, I mentioned we did some beta work, a year ago, and then it was part of our upfront with national networks for this year and ongoing since October 1st. But in order to build the bridge, in order to build the comp, and by no means am I saying GRP is the end-all, be-all. It is, like I said, a step backwards to take measures, step forwards, because we are going to evolve that. But it is that bridge for the money. And so in order to build that bridge, you need to start with comparable programming and rates across the media and the way it's consumed. So on that scale, the money goes from national nets. Moving forward, that will expand to video networks and or other publishers and or cable providers, et cetera. So we expect that going into next year that it will be elaborate.
So it's time for online video to get a grip. Anyway, that's old school.
Tony Jarvis, Olympic Media Consultancy. Unfortunately, I have a research background as well as working very closely with planners and buyers. In the real-time planning or buying environment, whether in fact it's real-time as in digital or post in some period of time as in traditional radio or television, we have a real dilemma. You need the cost, which is in dollars, and you need comparable value, your GRP, or what we might call a target rating point. Unfortunately, across the digital world, whatever screen you want to examine, but even more important, in the traditional world, even within television, we have all sorts of different currencies that are not comparable. So a GRP is not a GRP, is not a GRP, and what is GroupM and the agencies doing in America, which is way behind the rest of the world in media measurement, to bring TRPs to a comparable level so that we can really take a 360-degree planning approach and serve our clients optimally.
You want to take that one?
Yeah. So Tony, I'm going to point you to the committee to, but basically, what are you saying? You're saying you want a lowest common denominator?
No, I'm just saying we want comparable value.
Well, let me start.
Just take television. Just take basic television. Let's go into the old world. Spot television is measured 3 different ways, so it has 3 different GRPs. Guys, well, it's true, whether you like it or not.
No, but that's the methodology you're talking about.
Network is different again. So right within traditional television, we have 4 measures. Well, I know we have a dollar value.
Tony, you're talking about methodology, how you get to what that GRP is. But once you get to that, however the industry agrees on it, that's what the GRP is, right?
But it's not comparable.
Okay. So this is a conversation for an ARF or other organization. Okay. Sorry.
Well, one key thing that I'll add to that is that realistic, and again, not to upset folks in the room, but the true market value in digital is, to date, has been perception. There is no rhyme and reason to rate, or there is no true market, because we're talking about, in some cases, 500 ads per user per day. So frequency is off the charts, So if you wanted to buy audiences, which is RTB's fashion, 500 times a day I can bid, which means that I can bid lower. And with a flawed attribution scheme in most cases, which is last view, you're actually incented to buy the last impression closest to the time of action at the cheapest price. So if you look at it and say comparable, yeah, there's a lot to be fixed in this equation, but I'm not going to go into attribution, and I'm not going to go into the right prices, but because that's all TBD. But the GRP examples that I gave will allow us to normalize some of this to actually put a value on what an impression would be worth or what an audience would be worth.
So the new ad tech acronym of the day, TBD.
Hi, Jim Shaw with OpenX. Can you talk a little bit about your planners and buyers and what the process is in terms of their decision making, whether they should go back through your trading desk, whether they should use an ad network, whether they should use a self-service platform? How do they determine what they should do with the buy? So
again, at GroupM, we've set up planning, or AKA the strategic engineers, and then the investment group. They collaborate on everything. So the first step is for the strategic engineers to obviously get a much better handle, much better relationship, much better strategy with their clients first. So understand goals and objectives and understand all the KPIs involved. That's first and foremost. Then the investment team works with them on who the best partners are or tactics they can take in order to accomplish those KPIs. RFPs and or decisioning goes out, and then based on math, if it's really any campaign, because brand itself comes back to metrics, right? We can see purchase intent and message recall, and then plan and buy that way. The math, again, it becomes a determining factor. In some cases, sexy and shiny still wins, and that I don't see that going away anytime in the near future. But it's a complement back and forth between the strategic engineers and the investment group in order to put the best plan in front of the client in order to accomplish all those KPIs. When KPIs are missed, it's fury. There's hell to pay.
Well, Ari, thank you so much. I have a bunch more questions, but we don't have any more time, so you're going to have to come back to do another one of these, okay? Or else we'll get your machine to come.
I appreciate it. Hope I didn't offend anyone too much.
Thank you, Ari.
I appreciate it.